For decades, Iran believed it held one of the most powerful strategic cards on Earth. Control the Strait of Hormuz, and you could threaten the energy lifeline of the global economy. But in 2026, that assumption began to crack. Quietly, rapidly, and perhaps permanently, the Gulf states started building a reality in which Hormuz no longer decides the fate of world oil markets. What was once Iran's greatest leverage is now being bypassed in real time. Every country that links its exports into this emerging alternative system removes itself from the list of nations vulnerable to Iranian pressure through Hormuz. That is the revolutionary change underway. The old geography of dependence is being replaced by a new geography of redundancy. Instead of one narrow maritime choke point controlling the flow of energy, multiple pipelines, ports, terminals, and coastal routes are being connected into a distributed network designed to survive attack, disruption, or blockade. The more nations that join it, the more valuable it becomes. Every new pipeline segment, every storage terminal, every port expansion adds another layer of resilience. The crisis of 2026 accelerated this transformation at extraordinary speed. Projects that would normally remain trapped for years in studies, tenders, environmental reviews, and political bargaining were suddenly moved onto emergency timelines. What once looked like long-term infrastructure dreams became urgent national security necessities. Governments that previously debated costs began calculating the price of inaction instead. In a matter of months, strategic energy planning across the Gulf shifted from efficiency to survivability. Iran's traditional advantage was simple. If almost all Gulf exports had to pass through one corridor, then threatening that corridor created leverage over everyone. But a bypass network changes the logic entirely. Iran cannot shut down the whole system by hitting one point, because there is no longer only one point to hit. If Fujairah faces disruption, cargo can be redirected elsewhere. If Khor Fakkan is damaged, other terminals continue operating. If eastern Saudi facilities are targeted, westbound pipeline routes to the Red Sea still function. Instead of a single artery, the Gulf is constructing a circulatory system. That difference matters militarily. Choke points are vulnerable because they concentrate traffic, risk, and fear into one place. Networks are harder to break because they disperse all three. A missile strike against one facility can damage infrastructure, but it cannot erase the larger system. A drone attack may create headlines, but headlines are not the same as strategic success. Temporary interruption does not equal permanent paralysis. Iran has already attempted to prove otherwise. On March 16th, Saudi Arabia announced it intercepted 35 Iranian drones targeting the kingdom's eastern energy zone. Around the same period, a fuel depot near Dubai International Airport caught fire after a drone strike, and Oman's Duqm port reportedly sustained damage. These were not random acts. They were strategic messages. Tehran was signaling that any attempt to route around Hormuz would carry a cost. It wanted investors, insurers, and governments to doubt whether bypass corridors could ever be made secure. But the attacks also revealed the limits of that strategy. Strikes can raise insurance premiums. They can delay shipments. They can force temporary rerouting. What they have not done is restore the old monopoly of geography. Once multiple export options exist, even successful attacks become operational problems rather than systemic disasters. The world energy market notices disruption, but it no longer panics in the same way when alternatives remain open. At present, the bypass network covers roughly half of the traffic that once depended heavily on the Strait of Hormuz. That number alone would have sounded improbable years ago. Yet the significance lies not only in current capacity, but in momentum. The pipeline expansions and port projects now under active planning are intended to close the remaining gap permanently. If completed, they would represent one of the biggest shifts in global energy logistics since the late 20th century. Among the boldest proposals is the Musandam Canal concept. For decades, it was discussed as an engineering fantasy. In 2026, it entered serious strategic conversation. The Musandam Peninsula, belonging to Oman, juts northward toward the Strait of Hormuz like a stone gate. At certain narrow sections, only about 20 to 50 kilometers of land separate waters connected to the Persian Gulf from the Gulf of Oman and the open Arabian Sea. If a canal or major transit corridor cut through that land, tankers leaving Gulf ports could bypass the strait entirely. The implications would be enormous. Ships could move directly to open sea without entering waters vulnerable to Iranian interdiction. They would avoid mined zones, avoid sailing close to missile batteries along the Iranian coast, avoid harassment by fast attack craft, and reduce exposure to electronic warfare systems such as GPS jamming. It would not merely be a new route, it would be the strategic downgrading of Hormuz itself. Yet geography does not surrender easily. Those 20 to 50 kilometers are among the most difficult terrain in the region. The Hajar Mountains rise sharply, in places approaching 2,000 meters. The rock formations are ancient, fractured, folded, and geologically complex. Layers of oolite and limestone thrust upward by tectonic forces over millions of years. Excavation through such terrain would be vastly more difficult than digging through soft coastal plains. Engineers would confront unstable slopes, seismic considerations, groundwater management, and immense blasting requirements. Then comes the financial burden. A canal capable of handling modern supertankers would require colossal excavation volumes, dredging systems, lock or sea-level design decisions, environmental mitigation, and years of construction under intense regional scrutiny. Costs could reach into the tens of billions, perhaps more, depending on scope. Security during construction would itself become a strategic challenge. Any such project would need military protection, international financing confidence, and long-term political guarantees. Even if a canal never materializes, the fact that it is being seriously considered tells us something profound. The old assumptions are broken. When nations begin discussing mountain-cutting megaprojects to escape a choke point, it means the choke point has become strategically intolerable. The value of Hormuz as a coercive weapon declines the moment alternatives no longer seem impossible. This is the deeper story of 2026. Iran may still possess missiles, drones, mines, and the ability to create danger. But danger alone is not the same as leverage. Leverage depends on irreplaceability. And step by step, pipeline by pipeline, terminal by terminal, canal by canal, the Gulf is building a future in which Hormuz is no longer irreplaceable. Imagine spending decades building weapons for one battlefield, only to watch the battlefield disappear. That is the strategic nightmare now confronting Iran, as Gulf states explore projects so vast they could redraw the map itself and make the Strait of Hormuz far less important than at any time in modern history. The engineering challenge behind these plans is almost difficult to comprehend. The Musandam route, often discussed as the most direct bypass option, cuts through some of the hardest geological formations in the region. This is not loose sand or flat coastal plain. It is ancient mountain rock, compressed, uplifted, fractured, and hardened over millions of years. To create a navigable passage for modern VLCC supertankers, vessels stretching roughly 300 meters in length and weighing more than 300,000 tons fully loaded, a canal would need immense dimensions. Depth would likely need to exceed 25 meters, with widths in the range of 200 to 300 meters, depending on traffic design, safety margins, and whether two-way passage were required. That means removing millions upon millions of tons of rock. Entire ridgelines would need to be cut down, slopes stabilized, channels dredged, and surrounding terrain permanently reshaped. This is not ordinary infrastructure. It would be one of the most aggressive civil engineering interventions ever attempted in mountainous terrain. The often cited figure of $100 billion is generally considered an optimistic lower-end estimate rather than a realistic final cost. More serious engineering assessments place the likely price between $200 and $300 billion once excavation, stabilization, marine works, security, environmental mitigation, worker housing, logistics chains, and overruns are included. For comparison, the Panama Canal expansion, one of the largest modern maritime projects, cost around $5 billion. Musandam's harsher geology, deeper draft requirements, more difficult access conditions, and seismic considerations could multiply that scale many times over. The seismic risk alone is substantial. Excavating through folded limestone and oolite structures can trigger instability, collapse zones, groundwater complications, and long-term maintenance problems. Unlike softer sediment environments, mountain rock may appear stable while concealing fracture networks that become dangerous once massive cuts are introduced. Engineers would need to model slope failures, vibration impacts, and potential fault line sensitivity for years before full construction could safely begin. Then there is the environmental cost. Dredging and excavation on such a scale would alter coastal circulation patterns, sediment transport, marine habitats, and potentially groundwater systems. Local ecosystems shaped over centuries could be changed permanently in a single decade of construction. That is why advanced planning models describe the proposal not simply as a canal, but as one of the boldest confrontations between human engineering and natural geography ever contemplated. Yet governments continue studying it, because the geopolitical reward may justify the staggering bill. If successful, such a route would allow Gulf exports to reach open ocean while sharply reducing dependence on waters vulnerable to Iranian disruption. In strategic terms, it would convert geography from a liability into an asset. An alternative concept attempts to avoid the mountain problem entirely by accepting a different kind of extreme. The empty quarter canal proposal envisions a channel roughly 950 kilometers long, beginning near Saudi Arabia's southern coast, crossing the Rub al-Khali Desert, and connecting toward the Gulf of Oman. No towering mountain wall, no deep rock cuts through jagged ridges. At first glance, the terrain appears far easier. But deserts create their own tyranny. A canal of that length across one of the hottest and driest places on Earth would face relentless evaporation. Without continuous water management, salinity would rise, mineral deposits would accumulate, and operational reliability would deteriorate over time. Wind-driven sand intrusion would create chronic silting problems, requiring constant dredging. Maintenance costs over decades could rival construction costs. Even the idea of flat desert is misleading. Sections of the route include elevation changes approaching hundreds of meters, in places nearing 700 meters, depending on alignment. That means locks, pumping systems, major excavation, or complex route redesigns. Earth moving would still be immense. In addition, proximity to the Yemen frontier introduces a security problem that engineering cannot solve. Infrastructure can be built against nature more easily than against persistent regional instability. A Saudi-linked feasibility estimate years ago placed the concept near $200 billion. But inflation, materials costs, labor demand, and security requirements today could push any modern estimate significantly higher. What the empty quarter option does offer is simpler land acquisition, lower population displacement, and potentially less ecological disruption than blasting through mountain coastlines. The Rub al-Khali remains one of the least populated regions on the planet. Neither canal is likely to be completed in this decade. But that is not the most important fact. What matters is that both are now being modeled, debated, and studied with a seriousness that barely existed before the Hormuz crisis of 2026. In only months, ideas once dismissed as speculative megaprojects entered the realm of state-level strategic planning. That shift reveals the deeper logic driving the entire bypass movement. Iran built much of its regional leverage around one geographic reality: control of the northern side of the Strait of Hormuz. Cargo moving through that narrow corridor entered the engagement envelope of Iranian missiles, naval mines, fast boats, drones, and coastal surveillance systems. In confined waters, even a smaller power can impose outsized risk. But geography is no longer fixed in the way it once was. Analysts increasingly describe this moment as the opening phase of a geoengineering era, where states do not merely defend terrain or seize terrain, they redesign terrain. Pipelines beneath deserts, export terminals beyond choke points, artificial logistics corridors, and canals through mountains all represent strategic acts that can neutralize military advantages without direct battle. If tankers no longer need Hormuz in the same numbers, then much of Iran's carefully assembled toolkit loses relevance. Naval mines optimized for narrow, shallow channels matter less when ships choose different routes. Fast attack craft designed for strait harassment become less decisive when traffic disperses elsewhere. Coastal missile batteries aimed at dense shipping lanes lose leverage when those lanes thin out. Electronic jamming systems covering one corridor become less valuable when commerce shifts beyond their reach. Weapons without traffic are not strategy. Mines without ships are storage inventory. Missiles without choke points are deterrents with declining utility. Boats built for one narrow arena become expensive symbols of a fading doctrine. This is why the real battle of 2026 may not be fought at sea at all. It may be fought in planning ministries, engineering firms, sovereign wealth funds, dredging contracts, and pipeline corridors. Iran spent years preparing to dominate a map inherited from nature. Its rivals are now asking a more dangerous question: what if the map itself can be changed? For 40 years, Iran invested in one strategic formula: make the Strait of Hormuz dangerous enough, and the world would always have to take Tehran seriously. That formula depended on one condition above all others: that ships still needed to pass through Hormuz. Once that condition begins to disappear, the value of everything built around it begins to erode. This is the true significance of the bypass infrastructure now expanding across the Gulf. It does not need to destroy Iranian missiles, sink Iranian boats, or clear every minefield to weaken Tehran's leverage. It only needs to reroute around them. A weapon designed for one corridor becomes less decisive the moment traffic chooses another corridor. Geography-based power can be neutralized not only through force, but through alternative geography. At a negotiating table, the side that realizes its strongest card has quietly expired loses more than bargaining power. It loses credibility. Iran cannot reverse the existence of pipelines already laid beneath the desert. It cannot unbuild the East-West Petroline carrying crude toward the Red Sea. It cannot erase the Habshan-Fujairah pipeline that already links Abu Dhabi's oil fields to the Gulf of Oman. It cannot prevent expansion at Fujairah, Khor Fakkan, Duqm, Yanbu, or future export terminals designed to bypass vulnerable waters. It cannot stop engineering studies once governments decide strategic necessity outweighs cost. That is why this shift is so consequential. The threat is being canceled not by confrontation, but by construction. The economic implications extend far beyond the current crisis. For decades, global shipping markets priced in the permanent possibility that Hormuz could be disrupted. Tankers entering the region paid war risk premiums and elevated insurance rates because investors knew a narrow strait under geopolitical tension carried unique danger. Those costs were passed down the chain to refiners, utilities, factories, airlines, shipping firms, and ultimately consumers across Asia, Europe, Africa, and the developing world. When bypass routes begin carrying larger shares of Gulf exports, that risk premium starts to decline. Insurance models change when dependence on a single choke point declines. A tanker loading at Fujairah or another outlet beyond the strait may be viewed differently from one forced through Hormuz during a crisis. That translates into lower delivered energy costs and more predictable supply contracts. The commercial value of places like Fujairah, Khor Fakkan, Duqm, and potentially one day a Musandam transit route is not just safety. It is reliability converted into money. Saudi Arabia and the UAE are not only exporting oil through these routes, they are exporting confidence. Confidence that cargo will arrive, that contracts will be honored, and that political blackmail cannot easily interrupt flow. That may be even more valuable than the oil itself. In this sense, Gulf capital is evolving from resource wealth into infrastructure power. States that once relied primarily on selling hydrocarbons are now positioning themselves as sellers of certainty. They are building logistics systems, terminals, storage hubs, ports, pipelines, refineries, and maritime insurance ecosystems that energy importing economies will pay premiums to access. This changes their role in the world economy. They are no longer only suppliers of commodities. They become architects of trade routes, rule makers, rather than merely participants. For countries such as Saudi Arabia and the UAE, whose long-term national strategies depend on attracting foreign investment, expanding tourism, building advanced industries, and becoming commercial crossroads, secure energy routes are foundational. Investors do not only examine tax rates or labor costs, they examine resilience. They ask whether supply chains can survive shocks. Every dollar spent on bypass infrastructure can generate returns not just through export volume, but through the broader trust that stable infrastructure creates. The nations hit hardest by Hormuz disruption demonstrate why this matters globally. China imports enormous volumes of oil each day, with a substantial share historically linked to Gulf supply. Even with large strategic reserves, reserves are finite by design. They are buffers, not permanent replacements. The longer a disruption lasts, the more Beijing must draw down stockpiles and seek replacement barrels elsewhere, often from Russia or more distant suppliers on less favorable terms. Every prolonged interruption can deepen Chinese energy dependence on Moscow and shift the Eurasian balance in ways lasting years beyond the crisis itself. Japan faces a different vulnerability. After Fukushima, Japan reduced much of its nuclear generation and relied more heavily on imported LNG and oil. Any instability in Gulf supply threatens industrial costs, electricity pricing, and broader economic competitiveness. Energy security in Japan is not abstract. It is tied directly to manufacturing strength and national resilience. South Korea's stakes are equally severe. Its semiconductor giants operate some of the most energy-intensive industrial facilities in the world. If power prices surge or fuel supply tightens, the effects would reach far beyond Korea. Semiconductor disruptions would ripple through smartphones, vehicles, cloud computing, defense electronics, consumer appliances, and global technology supply chains. India confronts another version of the problem. As one of the world's largest importers of crude, it depends on affordable, steady supply. If Gulf routes are impaired, India may need to source more cargoes from Africa or the Atlantic Basin at higher spot prices, with significantly longer transit times and increased freight costs. That raises inflation pressure in one of the world's fastest-growing major economies.